Okay, welcome to another tutorial video. As you can see, we're going to go back to venture capital and startups this time around and talk about venture debt, which is a little bit of a niche topic, but which is also interesting and something that I haven't really seen covered in a lot of detail elsewhere. So for all the files and resources here, you'll want to go to our tutorial on venture debt on our knowledge base. I will link to this URL. It's a long URL, so I'll just put it below the video and pin it in the comments there. This is an excerpt from our venture capital and growth equity modeling course, and you can get the Excel file, the slides, and the written explanation and screenshots in this link. So what is venture debt? It's essentially a newish type of financing for many startups that acts as a bridge loan in between traditional VC funding rounds, such as a Series A and a Series B, or between a Series B and a Series C. This is a crash course tutorial that will cover the main points with a few simplified examples. We're not going to get into all the nuances, but you will know enough to understand it and to calculate the returns on venture debt after this. So I'm going to start with the short version and give you a 2 or 3 minute answer. Then we'll go into the returns. We'll look at the impact on the cap table. We'll look at an Excel example of calculating venture debt returns for real with a couple of more complex formulas. And then we'll look at some advanced nuances and cap tables that are covered in the full course here. So as I said, venture debt is really a bridge loan that's in between major VC funding rounds, and startups like it because it lets them operate a little bit longer without incurring major dilution in the process. So for example, maybe a startup needs funds for another 1 or 2 years, but it doesn't want to take all the time and effort that would be required for an official Series A or B or C or something more intense fundraising wise like that. They also don't want to incur a lot of dilution. So maybe they own 50% right now, and they would be fine with giving up maybe 0.1% or 0.2%, but they don't want to give up 10 or 15% just to keep operating for another year or two. And in a case like this, venture debt can be very useful. Now, venture debt always has to follow an institutional VC round, and it is then repaid in the next VC round after this. So it really is a bridge loan. It doesn't tend to stay outstanding for long. In fact, the only reason it would stay outstanding for more than a few years is if the startup can't raise funds and eventually shuts down or stagnates or declares bankruptcy or something like that. Venture debt is not converted into common shares, so that makes it different from safe notes or convertible notes. There's usually some type of interest-only period in the beginning. There are usually loan fees attached, and there are usually warrants that give the venture lenders a % of equity in the startup upon exit, assuming an exit actually takes place. The potential returns on venture debt are higher than those on standard corporate bonds because the interest rates are higher, the fees tend to be higher, and there are warrants attached. So if we go into Excel and just take a look at our VD returns tab here, I've plotted this out, and the multiple of invested capital is 1.4x. The internal rate of return is about 12.4%. This is definitely higher than what you'd see on something like an investment grade corporate bond. And of course, the reason is that the interest rates are higher. There are loan draw fees. There is a prepayment penalty fee. And then when an exit finally takes place, the warrants activate and some of the returns come from that as well. Of course, there's another angle to this, which is that the default risk is also much higher because many startups do not get additional VC funding. Sometimes they just stall out. Sometimes they just die and declare bankruptcy. So yes, the potential returns are higher, but so is the actual risk incurred. Let's now go into this in some more detail and talk about the different components. So lenders can earn returns with venture debt in several different ways. There's the cash interest first off, and as I stated before, this is almost always higher than the rate on a standard corporate bond. So if we go back to our venture debt Excel file here and go down to the venture debt round after the Series A, here the interest rate spread is 7% to the benchmark rate. So this might be 10%, 11%, 12% in the current environment. This is quite a bit higher than what you'd expect to see on a corporate bond for Microsoft or Apple or some other company like that. There are also fees. So usually when the loan is issued, there's a fee, there may be a utilization fee, and if the loan is repaid early before 3 or 4 years or whatever it is, there might be a prepayment penalty fee such as 1 or 2%. So you can see it right here. We have the loan draw fees and also a prepayment penalty fee, and both of those contribute to the returns as well. There's also warrants, and usually these are well under 1% of the fully diluted shares in the company. So they might be 0.1% or 0.2%. In this case, it's 0.1%, and so that results in 1,538 warrants for the venture debt investors. The exercise price of the warrants is based on the share price in the previous round. We went through how to calculate that share price in our cap table tutorial. It could also be based on the share price in the next round, but obviously, usually the lenders want it to be the lower price in the previous round so they earn more when these actually become exercisable upon exit. The trickiest part of all this is getting the warrant math right because the time frame is quite extended. There could be new investors in the future. And so even if they get around 1,500 warrants here, by the time you get to the exit, scrolling down in this file, it's actually a little bit tricky to figure out whether they exercise the warrants and then what the net proceeds are, factoring in the percent of equity they own and then the amount they actually pay to exercise the warrants. In terms of the impact on the cap table, there isn't a real impact in the beginning. There might be a 0.1% or 0.2% impact if we go up and look at our venture debt round right here. Before issuing venture debt, co-founders own 65%, employees own 10%, the Series A investors own 25%. After issuing the venture debt, the co-founders own 64.9%, the venture lenders own 0.1%, and then the employees still have 10%, the VC investors still have 25%. So there is a very small impact here from these 1,500 or so of warrants that are issued, but it is very, very minimal compared to traditional priced VC rounds. There is debt repayment, in this case when the Series B round takes place, but that doesn't actually affect the share count. It does affect the company's cash balance. And so when you look at something like the exit calculation, we just skip directly to the exit equity value here. But if you did not, the amount of cash used to repay the debt could indeed affect this number, but we're not really showing it here. We're just simplifying this a little bit. However, the debt repayment does not actually affect the share count and the ownership of these different parties. So now let's go into the Excel example. And to set the stage, we're assuming a Series A for $5 million at a $15 million pre-money valuation, a 10% options pool, and a 1x liquidation preference. The venture debt is $2.5 million in year 2. So right after the Series A, there's a 1-year interest-only period, 3 years of amortization, and then the penalty fees, interest, and warrant coverage we went through before. The Series B takes place after this in year 5. It's $15 million at a $50 million pre-money valuation. There's a 20% options pool and a 1x liquidation preference. The proceeds are also used to repay the venture debt. And then finally, the exit takes place in year 8, and it's a $200 million exit equity value. So the first thing here is that you need to set up the full cap table, and we went over this in previous tutorials. We're not going to go through the whole thing again here. We just don't really have time. But the bottom line is that you need to get to each entity's ownership upon exit, and you need to track what happens through these different funding rounds as the options are issued, as the options pools are upsized, and so on and so forth. When the exit takes place, you need to know whether each set of option holders and warrant holders actually exercise their options or warrants. So for example, one simple thing you can do is look at the exit equity value and then compare it to the equity value when the employees got their options or when the venture lenders got their warrants. And you can assume that if it's higher, they can probably exercise the warrants or options. And if it's not higher, then they cannot. And that's what we're doing here. Now, this is a simplification. You would normally want to look at this on a per share basis, but we just don't have time to get into it here. And it would make the model quite a bit more complicated. So we're just doing it in a rather simple way. The end result is that when this takes place, the venture lenders have a certain percentage of ownership, and then we take the percentage ownership times the proceeds that are available to them, around 133 million right here, and then we subtract out the amount that they pay to exercise their warrants, the 20,000 here, and so they end up with around 117 or $118,000 in proceeds in this case. Now, when you actually go and track the venture debt specific terms, you want to start with the issuances and repayments and simple date check formulas. Some of this gets a little bit complicated, but let's go over to our sheet and see how the formulas work. So first off, we need to bring in our interest rates here, and I've just projected the benchmark rate and I've added the spread to it. For the beginning and ending debt balances, we take the beginning debt and link it to the ending debt in the previous period. The issuances are pretty simple. It's just a date check. So we look at the year number, and if this is the year of the venture debt issuance, the VD_date, we link in the principal amount that gets issued. Otherwise, we say 0. Now, for the repayment in the Series B round, this is also pretty simple. We just look at the year number, and if this is equal to the date of the Series B round, Series B_date, then we sum up everything above and we assume full repayment. Otherwise, we say 0. For the principal repayments, this part gets a little bit tricky because we only have these after the interest-only period is over and before the maturity of the debt. So we need to check 2 conditions. First, we need to make sure that the year is after the year of the venture debt issuance and also after the interest-only years that are associated with the issuance. At the same time, we also have to make sure that this is on or before the venture debt maturity, because if it's not, we don't want to have anything here. If both those conditions are true, then we want to take the minimum between the remaining balance so far and then our initial principal issued divided by the number of years over which we're amortizing this. And this just handles the case where we've already amortized so much that there's only a little bit left. We don't want to amortize the full amount. We just want to repay the entire remaining amount. So we have that, and I'll say 0 if these conditions are not true. I made a mistake here and I didn't sum this up correctly, so let's just go in and fix that. And now we have that. Let's see what this looks like. And so you can see the pattern right here. We have the interest-only period first, and then we have 2 principal repayments, and then a final repayment here when the Series B round takes place. Now for the interest expense, this is pretty simple. We can just take the interest rate and then multiply by the beginning balance right here and copy this across from year 1 through year 10. And so you can see we have the 3 years of interest here and only 2 years of principal repayment because of that 1 year interest-only period in the beginning. Now, for many of these other line items, it's pretty simple. For the upfront investment, we just link to the issuances and flip the sign. For the loan draw fees, we just link to whatever the upfront investment was, and then we multiply by the loan fee percentage, which is a named cell right here. For the interest, we link up here and flip the sign because this is a positive for the lenders who are investing in this issuance. Principal repayments, also going to link to this and then flip the sign, and same for the repayment in the Series B round. The prepayment penalty fee is a little bit different. So here we have to look at the year number, and if this is less than the maturity date of the venture debt, then we will link to the prepayment fee and multiply by the repayment in this round. And I'll put a negative sign in front because we want to turn this into a positive. If we are after the maturity date, if we're on or after the maturity date really, then we'll just say 0. And then finally for the warrants, here we have to check the exit date. So let's look at the year number. And if this equals the exit date, then we need to go over to the cap table and get where we calculated the warrants to, or the value of the warrants to the venture debt investors after subtracting the amount they paid to exercise the warrants. If we're not on the exit date, this will be 0. So let's add this up and then copy this across so you can see what it looks like. And so you can see the returns profile right here. They invest something in the beginning in year 2. They get some fees from that. They get interest. They get the principal repayments. They get repaid upon maturity. There's an early prepayment penalty fee. And then they get the warrants in year 8 when the exit takes place. Now, if we calculate the multiple of invested capital, let's just do this. Let's sum up everything that is positive first. So say greater than or equal to 0. And then divide by everything that is negative. So I'll say everything less than 0 right here using SUMIF. And I didn't enter the range correctly. Let's fix that. So 1.4x. And then if we look at the IRR right here, it's around 12.4%. And this is how you can calculate the returns on a venture debt issuance. I just have a summary of everything we did in PowerPoint right here and some things to be careful about. Overall, this is a pretty standard result because 12.4% is slightly above the interest rate in this period, but not tremendously above it. It would be unusual if we had an interest rate of 10 or 11%, but the IRR somehow came out to 25 or 30%. There are some more advanced nuances here. For example, with the exercise price and share price, I mentioned in the Excel file how we're really simplifying it here. We're not looking at this on a per share basis, and we should be doing that. However, it would create circular references, which complicates everything quite a bit. You can also have cases where one VC investor group converts into common shares and another does not. Participating preferred and participation caps on the VC investments can complicate the exit calculations as well. And then with options, there's some complexity because you might have some that are vested and exercisable, you might have some that are unvested, and these could all be treated differently. So it's not quite as simple as what we're showing right here. And we do cover some of these added complexities in our full course. That's about it. So let's do a quick summary. Venture debt is a bridge loan, always done in between official institutional VC rounds. In general, returns are higher than they are on standard corporate bonds or potential returns, but the risk is also much higher, and there's a pretty decent shot that many of these loans will never be repaid. So, of course, the interest rates have to be higher to compensate for that risk. Lenders can earn returns via the cash interest, the additional fees from the issuance and upon repayment, and also from the warrant coverage. Typically, it's very low, 0.1%, 0.2% of the company's equity value, but it can still be substantial if the company does well. Venture debt, when it's first issued, makes almost no impact on the cap table. There's slight dilution, maybe of 0.1 or 0.2%, depending on the warrant coverage. With the Excel example, we went through it and looked at all these formulas. I think the trickiest part is just keeping track of the interest-only period in the principal repayment formula here and factoring this in correctly. Also, you have to be very careful with the warrant math and especially subtracting out the amount they pay to exercise the warrants. More advanced nuances, circular references for the share price calculations at the end, multiple scenarios, participating preferred, and also different treatment for different types of options and warrants and how those affect the exit. Hopefully now you should know a little bit more about this topic and you should have a good Excel-based example that you can use to follow if this ever comes up for you on the job or in interviews.